Investing in a changing economic scenario is challenging, especially amid times of inflation when prices of goods and services go up. In this video, we tell you how to choose the right stocks and cushion your portfolio when the going gets tough. For the sake of simplicity, let's divide the entire gamut of companies into two buckets. Number one, commodity-oriented companies that supply produce to others. And number two, consumption-oriented companies. These are the ones which essentially buy such commodities and make and sell products to consumers. Now, in an inflationary scenario, companies in bucket number one tend to benefit. They realize more revenue for the same product that they have made. Let's begin by taking a look at the winners or sectors that tend to benefit during inflationary times. Number one, mining companies. Mining companies are the biggest beneficiaries of inflation. As first-hand producers, their revenue increases at a faster rate than their expenses. This leads to expanded profit margins for commodity producers. The performance of their stocks is directly proportional to the expansion of their profit margins. In the past 2 years, most companies associated with this sector have performed extraordinarily well. Number two, commodity producers. Commodity producers are another big winner during inflation. In the current scenario, most commodity-oriented stocks have already rallied significantly. So how do you know whether the momentum in these stocks will continue? The answer lies in their operating margins. Commodities are heavily cyclical, and during inflationary times, the operating margins of cyclical companies tend to peak. It's counterintuitive to sell your holdings at peak margins. Greed generally overtakes rationality, and investors seek more from cyclical companies. Now, of course, there's no clear objective answers to when should one sell cyclicals, but plotting the historical margin trajectory should definitely give you some hint. There's a good chance that selling at peak margin point is making the right decision. Number three, consumption sector. Consumption is a long-term winner. During inflationary times, the purchasing power of consumers reduces, and subsequently, demand for consumer discretionary products declines. For this reason, consumption-oriented companies generally struggle to do well in inflationary times. Their expenses rise faster than their revenue growth. Consumption-oriented companies are relatively easier to analyze because the demand-supply cycles are stable. Inflation's impact on these companies is adverse but most often transitory. Well-run consumption-oriented companies successfully end up passing on their increased costs to consumers. Number four, banking and financial services. Companies in the services sector have no linear relationship with inflation. But banking and financial service companies are in general beneficiaries of inflation. As inflationary winds start blowing, central banks, as we know, tend to increase interest rates. At such times, the net interest margin for banks typically expands, and subsequently profitability goes up. So these are the four sectors you can look at during times of inflation: mining companies, commodity producers, consumption sector, and banking and financial services. Now, what to avoid in these times? Well, manufacturing and the entire construction sector are the clear losers. To sum it up, if you have the skill set to understand the demand and supply cycles of commodity-oriented companies, you can outperform most investors by investing in and exiting cyclical companies at the right time. But for those who may not be very adventurous, staying with consumption-oriented companies might be a good call. There will surely be some pain for consumption-oriented companies during inflation, but for those who believe in India's growth story, staying put with stable, consumption-oriented companies should work well for the portfolio in the long run. Hope this helps, and don't forget to like, subscribe, and share the video.